This is Neil Greene, President and CEO of JABOY Productions, welcoming you to today's Elite RIA and Family Office Virtual Conversations live webinar. We have a very exciting webinar planned for you today. Just a couple reminders before we kick off. We will have a virtual happy hour, which is kind of our staple that we've developed. So everybody that's here is invited to our virtual happy hour to keep obviously socially distanced, but we have attendees from all over the world that will hop on here and just kind of celebrate, talk about things that are going on leading up to the election, which will be a couple days after this, and also just kind of catching up. So again, remember that is coming up on October 29th. That'll be at 7 o'clock Eastern Standard Time. Everybody that registers with 10 will get a drink menu to enjoy as we convene on a virtual platform. Just as a reminder, we will keep everybody on mute throughout the entire webinar. However, if you have any questions, which I suggest you do present at any time, there is a tab there in Zoom that you can ask your questions. And then once we continue towards the end or throughout the program, actually, we can actually ask those questions. So don't be afraid to do that. Again, there is a website I can refer you to. It's 1031 Explained and Exchange, which is a website that has some details on 1031 exchanges, just the processes and things like that. And again, if you have any questions, you can address them through that website. And then we'll kick off our panel today. Our panel obviously is a topic which is very hot right now, and there's a lot of discussion. Obviously, as the political foundation right now is back and forth between Biden and Trump. But one of the things that I know the Biden campaign has been talking about is the future of 1031 exchanges. And I figured there's no better time to talk about it than, are they here to stay or are they going away? Nobody knows what's going to happen in a couple of weeks on the election, but I figured that we have an esteemed group of panelists that we're here to talk about, what should happen and obviously to prepare accordingly. So we have with us today, Mr. David Becker, Managing Director from Time Equities, Louis Rogers, which is the founder and CEO of Capital Square, Mr. Jeff Flahardy, which is National Accounts Director of ExchangeRight, and then John Forry, which is Managing Director of CBIZ MHM. I will be the moderator today, and at this point, I am going, and then just to follow up, so Mr. Louis Rogers will stick around, and we'll have a presentation on tax advantage real estate investments using qualified opportunity zones. So with that, what I'm going to do is I'm going to put the speakers here on the screen and just kind of kick it off. What I'd like to do, everybody, is first of all, thank you for taking the time today and obviously talking about this topic, which is on everybody's mind. Let's do this. If you can, first of all, let's start with Louis Rogers. Introduce yourself. Talk a little bit about your background real quickly and kind of what your involvement is in the 1031 exchange market.
Absolutely. Thank you. Thank you for having me, for having us. I'm the founder and CEO of Capital Square. We're a sponsor of Delaware Statutory Trust Investments, Opportunity Zone Funds, LLCs, and other similar tax advantage real estate investments. I'm a lawyer by training, an old lawyer by training. I woke up on a panel yesterday and I was the old guy, which really makes me very unhappy. I did my first exchange in the spring of '84 after law school. That's a long time ago, before most of our staff members were born. Now I'm starting to sound like my grandfather.
All right, Mr. Flahardy.
Thank you, Neil, and thank you again to everybody that's spending some of their afternoon time with us. My name is Jeff Flahardy. I'm the National Accounts Director for ExchangeRight Real Estate. I started my career working with securitized 1031 exchanges, obviously now in the form of a Delaware statutory trust, but previously as a tenant in common back in 2002 when they started. I served ExchangeRight in leading the charge with new broker-dealer accounts, RIAs, family offices, and educating them on what we do. ExchangeRight has two platforms, our 1031 DST platform, as well as what we call our Essential Income Fund, which is a Reg D investment focused on the same asset class that we do in our DSTs.
Terrific. David Becker.
Well, thank you, Neil, for having us. This is a great group of esteemed colleagues and professionals, so I'm happy to be on with everyone. So I run the equity department at Time Equities. I'm on the investment committee. I've been there a long time. We are a full service real estate investment development company. I think we're invested in we own maybe about 35 million square feet throughout North America, US, Canada, and actively invested in Europe. And as part of what we do, we buy office and retail and residential and industrial and student housing, sort of the major 5 sort of food groups. And we, of course, as part of our acquisition criteria, use a number of 1031 exchange platforms, customized strategies, and do it for our own account. So we're obviously waiting to hear what's happening, but we just got over this one, but we're gonna have to fight for it again, and we'll see what happens.
Great. John Forry.
Yes, thanks, Neil. I was raised on the East Coast, went to college and graduate school on the East Coast, and then came to California, spent 25 years here as a lawyer, practicing primarily as a senior partner with Morgan, Lewis and Bacchius, and then spent a few years in Hong Kong on international finance structures, primarily project finance, and came back to New York at the end of the 90s and left the law and became a partner in Ernst & Young, focusing on cross-border finance transactions, and spent about 5 years teaching full-time in 3 continents and about 5 graduate schools in international finance and taxation. And I'm now a managing director with CBIZ. That's a sort of excellent 4,000 person professional firm, primarily accounting, tax, and financial advisory, kind of like a small version of EY, if I may say so, smaller version, top 10, I think, accounting firm. And I'm enjoying myself, so that's good.
Terrific. So let's get to the matter at hand. So it's been openly discussed and announced that Mr. Biden, or running for president here, is talking about doing away with 1031 exchanges. Talk about you think the reality of that happening, and if it was, then let's go into what do you think some of the consequences would be in that scenario. So let's start off with David Becker.
Well, I think what sort of has to be realized is how many different business segments happen through a 1031 sale transaction. So the biggest concern we have is that that they don't reach the objective they're really shooting for, which is higher tax revenue and some sort of it seems to be some sort of a class warfare issue. And we hope that the political stuff doesn't, find its way through, because our position really is that this is net negative from a tax revenue standpoint. You have a whole bunch of things that happen through a 1031 sale transaction. And real estate is primarily an illiquid investment. And when you try and pull the liquidity or the buyer pool out of the group that's already there, you're just shrinking the liquidity element. And our fear is that what will happen is you'll have a whole bunch of sellers that essentially will opt not to sell. And so when that happens, think about all the transactions that will be affected, or all the business lines. You have title people, you have lawyers, you have accountants, you have banks involved, you have, so there's a whole host of things that happen with job growth, employment, people being active, economic activity, that we think will just essentially freeze. And of course, that will lead to negative real estate value. So our concern is that the net event will be negative, and it'll be negative from a real estate value point of view and an economic productivity standpoint.
Louis?
EY has run the numbers. It's an old study and it's being updated, but the old study showed 12 billion would be lost in revenue to the government if 1031 were eliminated. And so you have this big shiny object, all this tax revenue, $50 trillion, that turns into a negative in reality. And that's because the Joint Committee's numbers are static. They say you eliminate 1031, everybody sells taxable, and we have all this tax revenue. It's not really what happens. If 1031 is eliminated, you have the lock-in effect, right, Jeff? We talk about that in our lobbying.
Yeah, we've ExchangeRight, myself, I know Lewis, we spent time on the Hill together with the Federation of Exchange Accommodators, with the Investment Program Association, IPA, at ADISA, various industry group and stakeholders. And And we fought this battle, if we recall, what was it, 2016?
16, 17.
16, 17, when you had tax reform going through, because in that tax reform, there was a push for 1031 exchange repeal there. And, you know, what I found coming away from that, and this was several years of working the Hill, was that both sides of the aisle needed education. They needed studies like the Ernst & Young study that Lewis just mentioned. They needed the study from Ling and Petrova, who are also updating their study, which actually showed that in a tax they tracked, you know, quite a number of 1031 exchanges in a taxpayer's lifetime, and found a startling number that 88% of them within their lifetime exit their exchange taxably. So all of this, along with what has already been said, you know, kind of works to educate the Hill. I think one of the things that came out of the article from the panel that you were on, Lewis, that was really interesting was, you know, how the blue states would be severely affected by this. So they're in a way shooting themselves in the foot. So states like California and Oregon and Washington, you know, New York, where a lot of the 1031 exchanges happen, I think they're going to have a big challenge, you know, because there's going to be a lot of their constituents. I think it's just a really good sounding bite right now, generate some attention and make them sound hoo-rah-rah. But when you get down to the real granular effect of this, working this through House Ways and Means and the Financing Committee, it'll be difficult, I think, even with a Democratic Senate, you know, if we got that, and even with the Democratic president, I think they would still face challenges. But I'm sure, Lewis, barring any COVID restrictions, we'll probably see each other up on the Hill. So
See you in the swamp.
Yeah.
Very
John, from a tax perspective, I know you're a tax planner. What do you think the reality of what is proposed by Biden?
Possibility of this. Well, you know, I believe this is probably one of those provisions that is designed to be limited to people who make not more than $400,000 in a given year when the exchange takes place. That's really not a very realistic cutoff point, because in many cases there are people who may be making more than that, but are clearly not super wealthy folks. Nevertheless, they depend on this tool as a way of basically taking an illiquid asset and turning it into another similar asset, but one which is worth more than what they originally paid for their current one. It's not a very effective item to include if you're going to go about this in a class warfare way. And I think that's going to become pretty apparent. There may be other benefits not related to 1031, you know, which might be attacked, specific industry ones, or some of the ones I'll mention in a few minutes, or now if you want to. But this one is not. This is kind of like a garden variety staple within the real estate investor community, and it's just not realistic to impose such restrictions. It has a very strong negative impact on the liquidity of real estate, which makes it less attractive for people to invest in.
Right. So let's talk about that, the liquidity purpose. So, you know, obviously, other than you, John, there, you know, Lewis, Jeff, and David, you're involved obviously with real estate buyers and sellers. What are you seeing right now? Are sellers obviously trying to sell quicker, and there are buyers trying to just do these transactions, or is it kind of just not affecting the market right now? What do you see as the effect for the real estate market?
Well, this is David. I guess I'll jump into it just because we're involved in a whole host of real estate sales and acquisitions across the country. You probably could not envision a worse time for this. We talked about it yesterday when we were sort of prepping for the panel, but you have a lot of unknowns already out there. So when you add in sort of problems that you really don't know yet in terms of whether they exist from a real estate value point of view, and you throw this on, and of course, real estate people don't love the unknown. No one really does. Stock market doesn't either. And that's a big concern because the timing aspect of this, in addition to all the things that everyone has said, is a whole nother element. And I can tell you from our point of view, with financing costs so low, it's easy just to finance. And so if you have this added restriction of sale, I think you're going to find a lot of people just taking advantage of financing. And again, from an economic standpoint, you're going to see less liquidity, and it'll affect the real estate values of a whole host of people across the country, and they'll feel tightened, and it all relates down to consumer spending. So I'm hopeful that more practical minds prevail.
We had our first seller insist on a closing this year to lock in the tax. If 1031 were eliminated, they at least want to lock in the current income tax rates and capital gains rates.
So we're seeing some people concerned out there, which is obviously from the news.
Yes.
Yeah.
Yeah, we
What
have,
about you, Jeff?
Yeah, we've seen volume go up, right now. But the demographic, I'd say Lewis and I are generally serving the type of client is that older client in their 60s and 70s. Or doesn't mean we're not finding other clients, but a lot of the DST buyers, they're really looking for a passive way out of their active real estate, and all the more so. So actually, the whole disruption, the COVID-19's fueled it. I've seen some, struggles, going through March, April, May, maybe into June a little bit, of people trying to get their deals done. And then when, those people who got their deals done, that got the extension that carried them to July 15th, there was a little bit of a lag there as people were thinking through before July 15th rolled around. But beyond that, we saw nothing but steady growth. We have more demand for our product than we can fill right now.
Same here. And
Go ahead, Lewis. Sorry.
keep in mind the Biden proposal, which has a very long title. The title is The Biden Plan for Mobilizing American Talent and Heart to Create a 21st Century Caregiving and Educational Workforce. Needs $775 billion. And we have a little bit of a problem with our national debt to begin with. And the proposal doesn't even mention 1031. It just talks about rolling back unproductive and unequal tax breaks for rich people, basically, to cut to the chase. Doesn't say 1031.
it doesn't say 1031, but he's been in some whole host of interviews where he's indicated it. So I think we're just inferring that that's what it is. But I agree with you, Lewis. It doesn't specifically state it out.
It's extremely vague. And it was issued pre-COVID.
Pre-COVID, and it's very hard to make plans based on the unknown.
But you would think rational people would not enter into major tax reform in the middle of a pandemic when the economy is weak. And this piece could set off 20-30% of the real estate economy into a recession, depression.
I have a little bit of a different take on what I'm hearing from investors. We have demand too in terms of people that are in tune to it. But I think there's a whole host of investors out there that own property today that are not really focused in on the 1031 component of it. I have a lot of conversations with people where they don't, they've heard about it tangentially, but they don't really understand. And so I wonder how that plays itself out in the years to come as sort of they become aware when it actually affects them. Because we've said on other panels, and we've talked about it, that so much of people that hold general real estate, it's the everyday person, and the average trade is 500,000, and usually with debt. So they may think that this is targeting a particular billionaire profile or someone who's very, very wealthy, but I'm not sure that's really where it lands.
Right.
Part of the problem is we're a very narrow segment. You could lop us off and change the income tax rates. Millions of people are screaming, but get rid of some little real estate thing. We're a pretty small group of people. We're loud, but small.
Right. So what's being done about it? What do you guys plan to do to either lobby or to basically inform your clients and real estate investors about what's proposed.
We've been lobbying, Jeff. You want to talk about the Hill days and all that jazz?
Well, yeah, I haven't unfortunately been able to participate in a Hill Day this year. I don't know, Lewis, if you have, but I haven't been up there. I know Dave Fisher, one of our managing partners, been heavily involved. We actually launched our own PAC because we've supported, I've mentioned the Federation of Exchange Accommodators. For those who are not familiar with them, the FEA is the National Trade Organization for Qualified Intermediaries in the country. Well, they have an FEA PAC. We've, of course, contributed to the max allowable. And then because, we could only go so far with that, we formed our own PAC. We've supported Bill Haram's PAC. Bill's a qualified intermediary out of Virginia. IPA and ADISA, we're all involved in this. And, the PACs are good because that's, creating fundraisers on both sides of the aisle. The FEA tends to be a little heavy focused on the Democrat side for obvious reasons. And the IPA and the DISA tend to be more balanced in that regard. So we're hitting them on all fronts. So everything that is already underway, we're already fighting it. We're assuming that if Biden gets in office that he'll try to eliminate 1031. So that's our approach. And so there is actually a lot being done. And it's not just, as Lewis said, like our little slice of the world. We're talking about other major stakeholders, the Real Estate Roundtable, National Association of Realtors, and many others, the ag community, that are all involved in fighting for the preservation of 1031 exchanges. And I think, not to do a side trail, but I think it's important that we fight. Because as you remember, we were up there last go around fighting, but who was on the Hill talking about personal property exchanges? Nobody was fighting that battle. And guess what happened? It got repealed. Goodbye, it's gone. But 1031 real estate exchanges got preserved. So it's really important that we speak up, we fight up. If you're out there and you feel like, well, I'm just a little voice in the wind. No, we need everybody's voice, everybody's help. If you have funds to contribute, that helps. If you can join one of these organizations and go up to the Hill and make your voice heard, it is worthwhile.
Right. David, what is Time Equities and Francis doing right now about that?
Writing a lot of letters, being vocal wherever we can. Obviously, as it relates to Francis, he has a whole host of political people that he deals with. So he wrote a letter to Biden recently spelling out how he viewed this to be similar to the 1986 Tax Reform Act that really put everyone into a tailspin and ultimately led to what he said was the S&L crisis as related to real estate. So it was very dramatic. He's written direct letters to VP Biden and others, and just trying to, what he's really trying to communicate to them is that they're not going to reach their intended goal. And then when you look at particular states, and I think Jeff mentioned earlier, like in New York and California, that are so transaction heavy and you have such big values on the coast, that they're in desperate need of transactional revenue. In New York, it's almost 3% for mortgage recording tax. So, or other income taxes. So, if everyone froze, it would be negative. So he's trying to highlight that best he can.
Right. And obviously, Jeff, you mentioned about the, talking about and going up on the Hill. You don't have to be a professional lobbyist to do that. You can obviously communicate. I know that you've done that, and I've been involved as well as going up on the Hill, but everybody out there doesn't need to be a lobbyist just to go out there and have your voice heard. And Jeff, maybe you can kind of talk about that, but you can just literally make an appointment to go to Capitol Hill and actually go to see your representative for your particular district. It's not that difficult, but those are some things that can be done, or just particularly writing a letter to that particular representative. John, from the tax perspective from CBIZ, what are you guys doing as far as lobbying or, writing letters and, getting involved to hopefully combat this particular, situation?
Well, the firm and in general, I think the accounting profession is not going to be probably on the point this resistance. You know, I think we could be involved in this because if we think it's essentially ignoring the good public policy behind 1031. And I haven't been presented with any kind of position paper or whatever to comment on, but I think that could happen based, as I said, upon the public policy underlying 1031. I was looking at the list of alternatives, you know, that we discussed with our real estate investors on the buy or sell side. Of course, 1031's there, the DSTs have come forward. Those structures are so well understood. Doesn't mean that there aren't technical requirements and people can't make mistakes, but they're basically so well developed and so well serviced by people who are frankly, you know, on this panel and many others. And you compare that to qualified opportunity zones. Now, we're going to have a conversation about QOZs after this, but 1031 is a kind of one and done situation. QOZs are different. If you have to sell, generate capital gains, and now you're within the period where, almost within the period where you're only going to get deferral till the end of 2026 and no haircut on the amount of gain, which is taxable at that point. So what you're really looking at is not much of a savings in terms of the you know, cash, present value of the cash that you're saving. And you're instead waiting for the 10-year period to run after you've made the investment. There's also a lot of technical requirements associated with QOZs. And you're also asking investors to go into areas which are, by definition, economically impacted. So there's more risk involved in making those investments. You have older models like qualified small business stock, enterprise zones. These are pretty limited as to what you can invest in to get tax benefits. And they're nothing as broad-based as 1031, even after it's been cut back by the Tax Reform Act. Some more exotic options like the use of UPREITs, for example, which I think the average 1031 seller or even buyer is probably not too familiar with and probably doesn't really want to get familiar with. It's a pretty technical area. REITs are very highly regulated and so forth. You've got a few tax-free disposition alternatives for foreign investors in the US. Normally they're subject to tax when they sell, just like a US taxpayer would be if they sell US real estate under FIRPTA. They might be able to go into use REIT or REIT invested funds to get some tax benefits, but those again are highly complex. So I don't see any tools out there that we would just automatically recommend that our real estate investors consider ahead of 1031. There will be alternative, more limited alternatives that are out there. So I think that to the extent the policy of 1031 has been carried out to allow, you know, mom and pop apartment buildings to be exchanged and so forth without current taxation. There aren't any alternatives like that.
Hey,
So
Neil, Neil, just to jump on one comment, you know, and on the QOZ, you have to spend new money. So it's even more complicated because you actually have to have new money to renovate or reposition or build. So it's a whole different level of sophistication for your average 1031 typical investor. And like John said, they're going into an area maybe that's somewhat challenged today, where essentially the local municipality is encouraging you to go there and spend money. And so that carries more risk. The one thing I just want to comment from a real estate perspective is, you know, all else aside, a lot of people are focused just on income diversification. And so, and I know just by looking at this panel, what types of products are offered in terms of someone coming out of something they've had for a number of years, they've made some money on, it's appreciated, and then they have a moment to reposition, the same way you could reposition if you were in a liquid stock market and you go to a mutual fund strategy or rebalance your portfolio. So there's a lot of rebalancing importance that goes on just for the health and safety of a everyday investor. And so when that's taken away, aside from what it does to real estate values, I think about what it does to maybe the health of the investor, and it's negative.
Right. So the next question is, a lot of people actually have already transacted at DST and they have DST products with even you all, what happens if this thing goes away? What do they do at that point? Because a lot of these DSTs, let's say in 6 years, 7 years, they sell or you sell your portfolio. What does the client do at that point? What do you see as being the problem down the road?
We consolidate. Probably we end up in UPREITs, operating partnerships, big holding companies. And that's where the lock-in effect kicks in. We'll hold our properties and refinance them over and over again. The properties won't reach their highest and best use. The country won't experience the growth and the development of each individual property. Will be locked in. It'll be
Which leads to
terrible
liquidity.
detriment.
What does that do to liquidity of real estate? David, what do you think happens to liquidity if people aren't looking to or motivated to sell because you have no tax benefits? What does that happen to liquidity?
It's going to be less. And typically what helps real estate values is being able to know you can sell it and get in and out of it, because a variety of reasons require liquidity. And a particular property might require liquidity. So, you might not be in a position to actually spend the money on what the property actually needs to take it to the next level, but the next person might. And a lot of times I find that's why people are selling, that there's some event occurring and they're not the person well positioned to do it. The next person is, or the next investment company. So this relay is very important, and it's interconnected. And so to the extent that you put the brakes on the relay, a lot of different factors, a lot of different consequences come out of it. You can use finance. That's one way to do it. But I caution you that finance typically requires additional risk, and sometimes it's personal risk as it relates to debt. And unless you're a big company, it's not that easy to get debt on a non-recourse basis, depending on what your property profile looks like. So I think there's a lot of additional risk that comes out of this.
Jeff, what would happen? For example, you have a client that has, ExchangeRight Series 1. And obviously there's no opportunity to go to Series 2 because there's no 1031 exchange option available down the road. What happens to that client?
Yeah, well, fortunately, we're pretty uniquely positioned for that already, because back in March of last year, we formed our essential income strategy, which is basically a Reg D fund, as the primary takeout for our DST platform. And what that's done so far, while we have a 1031 exchange, is it's given investors an option. They could take their cash out, pay their tax, they could do another 1031 exchange, or they could do a 721 UPREIT into our fund, and we help them handhold that. As John had mentioned, that's a pretty complicated process. We have to track basis and things like that and ascribe debt to make sure they have a fully deferred 721 exchange. But we're actually already set up with for that. We set that up with the primary exit strategy for our DST portfolios to aggregate them. We always had an aggregation strategy from the beginning. And now that that's underway, if 1031 exchange was taken away from the taxpayer and they're in our 40 prior DSTs right now, as Lewis alluded to, we would do a large aggregation. We would just we would UPREIT those, put everybody into that fund. Right now, if we were doing that, that would make that fund 2.8 billion in assets under management. And then we would do everything we could to manage from there. But as others have mentioned on the panel, that's going to be pretty sticky money, because they're not going to want to exit. They're not going to want to convert their op units to the common stock, which is a taxable event, because they have all these accumulated gains. Where could we get liquidity for them? Most likely what we do at that size and scale is we would, at the right time, list that fund on a national exchange, and then leave the investor, the DST investor, in the driver's seat as to when and if in their lifetime they wanted to convert, some or all of their units to shares, pay some tax, and have liquidity, or hang on to those units till death do you part, get your stepped up basis, and then eliminate the gain that way, as long as that's not taken from us. So I would say, we're pretty uniquely positioned in a worst case scenario, losing 1031 exchange, because we're already set up for the uprate.
And I might add that point about not getting a stepped up basis is high on the Biden tax list as well. One of the common questioners, I think, suggested, what else can you do? And mentions accelerated depreciation. I mean, we have a very robust cost seg practice, which actually, the benefits easily pay for the fees it costs to do that. But again, all you're doing is you're getting the deductions on your income, but you're just driving down your basis with all these things. So eventually, you're still going to face the same problem from any of these internally applied current tax savings strategies, which don't really deal with the disposition or the desire to simply get out of an active asset into a more passive asset, for example.
Another question here, like, let's say, for example, this goes away. How resilient are your firms to pivot to do something differently? Let's talk about that. David, what would happen to Time Equities if you don't have DST product?
Nothing. We don't do DSTs. We do exchanges through a tick strategy. But I mean, either that, if the 1031 business went away, we have a host of investment funds, and we've been investing and have a large portfolio. And it would be for new business, really would impact some new equity businesses that we have. But in terms of our existing portfolio, or it wouldn't change what we're buying in terms of our assets and having other capital to buy those assets. It wouldn't impact us at all. It would impact us negative. Wouldn't impact us negatively because it's negative to the industry on values. But as a company,
would pivot from the 1031 to more of the income, tax advantaged income. Real estate still provides stable cash flow and good returns. Maybe the tax advantage part goes away, but there'll still be a demand for income, for yield.
Right. Jeff, you kind of talked a little bit about what you have. You have an income fund, but the income fund, would that be your primary business going forward, or should that happen?
Yeah, I mean, we would certainly, focus on that pretty heavily, even as we are right now, and it, focuses on the same asset class that we've loved. That, just as Lewis just said, I mean, income, investors need income. They like real estate, as long as it still has depreciation benefits, or if it's structured as a REIT, a 199A deduction. We focus on single tenant net lease, diversified portfolios, backed by investment grade rated companies or investment grade equivalent in the necessity, retail, and healthcare space. And we're pretty focused on what we do. It's been deemed essential, nearly everything we have. So we would certainly highlight that as a stable income. I would see our capital raise would go down because we're generating a lot of capital into the DST because of the 1031 exchange. And then I would say, in addition to that, in the right time, and that we don't believe there's enough market dislocation right now for deeply discounted opportunistic buys. At least we're not finding them. But we would shift in that area as well. We've done it in the past. We haven't done it lately because the market's been at a peak. We're sitting on the edge of our seat looking for those opportunities. So in addition to the essential income strategy, we would look for opportunistic type opportunities like we've done in the past to bring those to real estate investors who would want or desire them.
Right. All right. And last question here is, aside from what's happening with the Biden tax plan, should he obviously win, what keeps you up at night regarding real estate, given the current situation and going forward to the future? David, what would you think?
I would tell you right now, things are significantly better from a real estate point of view than we had feared back in March and April, when everyone was in full panic. I think the market has frankly surprised everyone. You have certain asset classes that have gained value, probably multifamily and industrial, and certain other credit rated type, secure income deals. Interest rates are unbelievably low. We're sort of waiting for the other shoe to drop, and we're sort of waiting patiently to sort of pounce on some new, interesting long-term acquisition opportunities. So I try and think about where those opportunities might be, where and what, and that's probably what keeps me up.
Right. What about you, Louis? What keeps you up at night about the real estate market?
Not the real estate, surprisingly. We've had 99% rent collections on apartments through the Southeast through this pandemic. Not medical, not industrial. It's this discussion we're having, this election, the class warfare, the divided country. That's what's keeping me up at night. The real estate's doing phenomenally well.
Well said, Louis.
Jeff?
Well, 97% of our holdings are an essential business. I mean, we have drugstores and grocery stores and dollar stores and, those type of assets that actually thrived in this market. So I have to agree with my fellow panelists. The real estate's doing fine. We've been 100% received across all portfolios. We're 100% received already in October, and we see no end in sight to that. So I'm with Louis. I'm more, concerned about the political changes and the effect that will have long-term on my children than I am about our real estate holdings.
Leave us alone.
John?
Yeah, let me.
Yeah, exactly.
Yeah, I deal pretty extensively, all 50 years of my practice, with international investors out of the U.S. and into the U.S. I see that after the Tax Reform Act of 2017, basically, that there was a definite awareness of the fact that the United States had become a much friendlier and more competitive economy from a tax standpoint, in terms of rates and in terms of ways you can structure transactions so that you didn't incur very high federal taxes. I would regret our going back to a high tax, high spending economy, which will discourage foreign capital from coming into the United States. I think it's important as a source of capital. It's also important as a source of bonds among countries, to have investors, private investors, and sovereign wealth funds as well, involved in your economy, because at that point they become concerned about the well-being of the United States, not just as an adversarial country.
Right. Okay, cool. Anything
one
else?
Footnote. Just one footnote. If we have high rates or no capital gains rates, but keep 1031, we're going to have to hire a lot of people at our firms.
We need more acquisition people.
More acquisitions. It'll be good for the economy.
Yeah.
It's true. David, any last minute comments?
No, I think we've captured it. I think we've all are all indicating that we feel pretty good about things, but the upsetting piece of everything right now is the division in the country and what this all looks like next year and a year beyond. So we can only hope for the best.
Neil,
Correct.
We need a virtual cocktail. Can you send us one?
All right, virtual cocktail. Don't forget, next Thursday. Hopefully, we'll see you all on that. That'd be terrific. So, with that tremendous job, I appreciate it, Jeff. Thank you. Cocktails are ready, and you don't have to drink a cocktail. You can have an iced tea if you want. But in any event, we appreciate your time, Louis. You're going to stick with us, and we have a continuing discussion on qualified opportunity zones, which I will bring up now. Some information on that. And so again, you'll also receive some follow-up with the group, which Louis and obviously everybody will follow up. So with that, our discussion at this point, we're going to continue with Louis Rogers. If I get to the page here, tax advantage real estate investments using qualified opportunity zone. So I'm going to take everybody else off the screen here. We got a couple other people that will be joining. So as I work on this here.
Okay.
Share your screen with Mark Slavny.
Yes, that's what I'm working on right here.
Thanks, everyone.
Thank you. Thank you, David.
Yeah, thank you. Bye-bye.
Thanks, fellas. Be safe.
All right. And then Mark, you should be good to go. Hold on.
There he is.
Okay, there he is. Mark Slavny and Mr. Louis Rogers. Take it away.
Okay, and James should be joining us as well. He's on there.
Colleague James.
Yeah, I
colleague
see
James Brumder. There he is.
There he is. Perfect. Okay, it's your floor right now, guys.
Great. So as far as sharing the screen goes.
Let me just see if I need to stop share.
Do we need a teenager?
Yeah, exactly.
Yeah.
There you go. You are ready. You should be good. There you go, Mark.
Okay. Very good. Thanks everyone for joining the call today. Obviously, we had a great discussion previously regarding the political environment. So now we're going to shift over to Capital Square specifically with tax advantage investing using qualified opportunity zones. Probably don't need to go back through Lewis's long and storied career and experience. Our founder and CEO has pretty much done it all. I make the joke that on a regular basis, he leaps tall buildings in a single bound. So with that said, James Brunger is joining us as well, our Executive Vice President and National Sales Director. A little bit about Capital Square. We've done, in our experience as a company in the last 8 years, over $2.2 billion worth of real estate transactions, over 80 different offerings, 110 plus real estate assets, over 2,200 investors are serviced on a regular basis with our firm. We have a national portfolio primarily based in the Sun Belt. Think of Virginia through about Texas, Arizona, focused primarily on multifamily housing. We also do industrial. We have a senior housing, manufactured housing focus as well. We do this through 1031s, DSTs. We do LLCs and the qualified opportunity zones we're going to talk about today. So with that, I'm going to shift to Lewis.
25 or so. Oh, there we go. Great. Thanks, Mark. Thanks, James. Are you ready to get in the zone? Yes. Yes, yes. In the zone. Let's talk about qualified opportunity zones. This was a part of the Tax Cuts and Jobs Act, was bipartisan, and the goal was to stimulate investment in low income and rural communities. And there's also a footnote, stimulate growth in areas contiguous to those areas. And so in a minute, we'll talk about Scott's Addition. Scott's Addition is the hottest developing neighborhood in Richmond, Virginia, our fair city. It is near low income areas, but it's not a low income area. And the goal is to generate this economic engine by providing tax benefits to investors. And we'll talk about it in the last presentation. We talked about 1031 exchanges, like-kind exchanges, Starker exchanges, all those sorts of things. And 1031 provides deferral. The gain that would have been recognized is deferred. It's deferred until the replacement property is sold in a taxable transaction. And we talk about the ability to exchange over and over and over again, building family wealth in a series of transactions that we call, and it's corny, swap till you drop. Now that's deferral. The ozone is sort of an animal that was designed by committee. It's a camel, you know. Why does a camel have humps? Because it was designed by committee. Next page, Mark. It's both deferral and exclusion. 1031 is deferral. If you die, you get a step up in basis and can have exclusion of gain. If you sell your principal residence, you can exclude the gain. And so they're somewhat of a hybrid. Hold on one second here. I'm getting something funny. There we go. So let's talk about the tax advantages on ozones. You initially have deferral. There's some elimination of the tax, and then there's complete forgiveness. So the most complicated part is there are two different things going on. You have whatever it is you sold. So 1031 is just real estate. Before the Tax Cuts and Jobs Act, it was personal property and real estate. Now it's just real estate. So if you're selling an investment or business property, you have 1031. If you've blown your exchange, you failed to do an exchange, you can do a qualified opportunity zone investment for deferral and exclusion. Anything else would not qualify for 1031. So Mark, what are we talking about? Stocks and bonds, and you're probably into Bitcoins, right? Things like that. All of those could benefit from an opportunity zone investment. And so you'll see there are three levels here. It is a little bit complicated. Whatever you sold in the 1031 world, we call it the relinquished property, but whatever you sold, you can defer that tax. How long? Until December 31, 2026, at which point that taxable gain becomes recognized. Now, if you've held for 5 years, you get a 10% step up. So you get 10% forgiveness, and the rest is recognized 12/31/2026, which for us natural persons means on April 15, 2027, we have to pay that tax less 10% for the forgiveness. As a footnote, Capital Square's Opportunity Zone funds have construction loans. We're building buildings. You'll hear about Ozone 5 and Scott's Addition. Our intent is to take the construction loans, make them permanent, and pull out some cash and provide a special distribution to the investors to pay their tax. So going back to the beginning, you have something that's not real estate, or you do a 1031, or you blew your exchange and you can't do 1031. You invest your gain within 180 days of recognizing that gain, and you invest it in a qualified opportunity zone fund. Come 12/31/2026, you deal with the first tax. Now you've invested in the fund. In Capital Square's case, we're building buildings in Scott's Addition. And if you hold that investment for a full 10 years, see on the right, your complete forgiveness. After 10 years, that tax is completely forgiven. So in 2030, the building's has long been built, it's long been stabilized, it can be sold, and that tax is forgiven, and you don't even have to die. So it's a hybrid, it's deferral, it's exclusion, it's complicated, it's a hybrid. It was built by Democrats and Republicans to create economic activity, and it has created enormous economic activity from coast to coast, has been successful. There's been criticism about reporting, and so we expect to have stricter reporting about how many jobs we've created and many of the benefits, more in the line of a marketing campaign to show that we're doing good deeds with our Opportunity Zone funds. Mark, next page. So here we are, stocks. These are all the things that qualify. Anything that generates a capital gain can qualify. Stocks, bonds, mutual funds. Sure, real estate, arguably 1031 works a little bit more efficiently, but some people forget to do an exchange, or they make an error, they cash out. A business sale, other assets, art, bitcoins, all those things qualify. And unlike 1031, where you reinvest your cash, in the O-zone, you reinvest your gain. So if you have a $100,000 gain, you sold $1 million property with a $100,000 gain, you reinvest 100,000, not the million. Within 180 days, if the entity in question is a partnership, you may have additional time. Your time may not start to run until the end of the year, might give you an extra 180 days. And you have a special tax form to file. You have to flag your tax return as an O-zone, no big deal. Next page, what is next here? Now we're getting into strategies. My colleague James Brunger is going to talk about CSRA GS, Ozone 5, which is a joint venture with Greystar, the largest property manager in the world. Not kidding, they are the biggest. They're an enormous developer as well. And I'm proud to say they chose Capital Square to be their joint venture partner to build this Class A sexy building in Scott's Addition, the hottest neighborhood in our fair city. James?
Excellent. Thank you, everybody. Really appreciate your time. Thank you, Louis. I caught the tail end of the panel there. And yeah, something you guys were alluding to is what happens if 1031 goes away. Well, if 1031 goes away and bipartisan O-zones stay intact as they are, they'll likely be even more popular than they have been simply for the tax deferral opportunity. And one thing too, I just want to note the capital gain deferral, that's good on both short or long-term capital gain. So any gain can be deferred to tax year 2026. That's come up very recently, mainly for the fact that you have a lot of people who maybe have had some pretty good opportunity here and realized some short gains this year through various movements in the stock market, other assets that they've been investing in. So that being said, it is my pleasure to introduce to you the Capital Square Greystar Opportunity Zone Fund 5. As that implies, we have 4 other offerings, one of which is months now into construction. At Capital Square, we are doing single asset real estate development, obviously being a real estate firm. This is purely opportunistic. So we look at opportunistic return profiles under the ozone structure. And that ozone structure gives you tremendous generational tax benefits that Louis kind of already alluded to. So 1031 exchange is multi-generation tax benefits for real estate. Opportunity zones are generational, this generation, once in a generation tax opportunity and elimination. And in our case, really true to opportunistic type of real estate. This project is in 1601 Roseneath Road. It's in the heart of a neighborhood called Scott's Addition, which is in our hometown, Richmond, Virginia, where Capital Square's corporate headquarters is based. As you can see here, about 350 total units. It is going to be the best in the market, the best property in Richmond as well. And in addition to that, because it's Main and Main, we'll go to the location here in a second. There's some ground floor retail, which will be in high demand, really truly the kind of cornerstone of the neighborhood. And then to Louis's allusion, we are very fortunate, very excited to be partnered with Greystar Real Estate Partners, a top 10 development company in the world, and by far the largest property manager in the world. And we're very, very fortunate that they chose to work with us, mainly because of our expertise in this market and the ability for us to deliver some really great opportunities, through our investors into a fund like this as well. So we're thrilled to be with them. Mark, go ahead to the next slide. Just digging in a little bit more about the location. We know this extremely well. This project happens to be about 20 minutes from our corporate headquarters. But in Richmond itself, one of the fastest growing and one of the best economic cities over the last decade, Scott's Addition is kind of the diamond in the rough that has also increased significantly. It is a prior industrial neighborhood. It's 4 miles essentially from the center of Richmond, about 3 miles from the state capitol. And for years, for the better half of the last century, it was truly the industrial neighborhood of Richmond. And like most other industrial neighborhoods, what you have is it was kind of a low rent district. And about 10 years ago or so, in that low rent district, you saw all of the breweries, restaurants, bars, you name it, became kind of the center point for activity specifically for the millennial generation in the Richmond area. So based on the 2010 census, which creates the opportunity zones, and then this was named by the representatives of Virginia as an opportunity zone, the area needed a little bit of economic improvement. Since the census over the last 10 years, there's been some capital expenditures growth, and it really has become the hottest neighborhood in Richmond. Mark, go ahead to the next slide. So to give you a little bit of scale, as I was alluding, there are breweries, 13 beverage producers, meaderies, cideries. They've all moved in within the last 8 years. There's a Michelin-starred restaurant. There is some of the typical support you see, grocery stores, et cetera. But as far as nightlife and activity in the great city of Richmond, this is it. This is where people go. This is where they, enjoy themselves generally throughout the week and the weekend. And then most importantly, many of the city's employers have decided to also move and set up office space here. And that's really been a trend over the last 4 or 5 years. So let me be clear, this was great real estate before the economic opportunity zone designation, one that we were looking at for development anyway, one that we actually frankly had acquired land in. And then when the ozone designation came about, it just added a little more fuel to the fire to create an even bigger opportunity for economic growth and incentives for the neighborhood. So what we are seeing now is a recognition that the live, work, play that the millennial generation has looked for. A lot of top employers, specifically the ones in the industries that we really like, technology, financial services, even healthcare, they're relocating or putting their office space in or around the greater Scott's Addition area because they want to be able to tap into the employment that the millennials possess. As you can see by the shaded out area, this really is a full city block. That is essentially the historic center of the Scott's Addition neighborhood, and we will have the Main on Main location. So arguably the absolute best location you can possibly have. Mark, go ahead to the next slide. One of the most attractive things was both the history that we had seen and then the projections that we had seen on a rental growth rate. And let me just kind of back up on Richmond as a whole. Since the pandemic, Richmond has continued to see rental growth. It is one of these cities, as you have some of the gateway urban core, in this case, Washington, D.C., and the work from home trend line, as well as people looking for a little bit lower cost of living. We've seen Richmond really kind of continue its trajectory throughout the pandemic. And then Scott's Addition is a key neighborhood. We've also seen that rent growth maintained. So you can see here the projections go out through 2029, a nice steady growth to the overall rental rate. There has been a slight flattening here in the second quarter from the product that's currently in market, but we are building into a really underserved housing community. There really is almost no housing options. As I've said, the bars, the restaurants, everything else is there. There has not been a lot of deliveries into this market. And so rents have remained stable through the pandemic. And then we also see these projections, even with some adjustments, continuing to look very good in the future. So again, we love this neighborhood, period. The economic opportunity zone side of it just adds a little more of an incentive to it. Louis, you were going to add something?
And we're seeing 3 to 4% rent increases per annum. And that's in spite of the pandemic. There's not a lot of product and there's a lot of demand. And so when new product comes online, it rents overnight. The occupancy is 97% plus. And so it's a hot neighborhood. It's the place to be. And we're building beautiful mixed use apartments in our own neighborhood. And we're getting the benefit of the opportunity zone tax benefits.
And you know what, too, just to allude to our expertise, Mark, go ahead to the next slide, but to allude to our expertise in the area, we do have over 2,000 rental units in our portfolio in the greater Richmond area through our DST programs. We've been active in this space since day one. So we have, you know, not just here in the Scott's Addition neighborhood, we obviously have a good feel for the entire area and what's going on. And we've seen those type of growth rates and those continuation of stable occupancy through the pandemic. So part of the reason why our 99% collection is maintained is because we do have a pretty good concentration in the Richmond area, which has done extremely well. And to that matter, Virginia unemployment has remained very competitive, very strong, even as you've seen kind of a national spike. Virginia itself, still one of them, it ranks consistently as one of the friendliest business climates in the country. You know, the unemployment rate really has not, we didn't see a massive deterioration even at the beginning of the pandemic. And through the pandemic, if anything, we've seen a recovery at a pretty quick rate here as well. So obviously, the reason why this makes a great investment for anybody is the ozone. Louis went through the tax benefits. The location just cannot be beat. This is truly the corner of the neighborhood in a full city block. The neighborhood, as we've alluded to, they've added 3,500 residents just in this neighborhood in 7 years alone, and that's with almost no supply of housing. So we will see that number continue to accelerate even as the Richmond market expands. And then obviously, as I discussed, there's the retail, the restaurants, the nightlife, but in addition to that, the office space, which generally this is a walking neighborhood. Richmond as a whole for years has not really been that urban walkable city. There are now very significant pockets that have opened up in the last 10 years that are walkable, downtown, Shockoe Slip, and a few others. But Scott's Addition really is kind of the core of that, and the core of that movement, capturing those the millennials as well as the individuals who are looking for that kind of a lifestyle where you can just walk to work or walk to the grocery store, restaurants, whatever else it may be. Mark, do you mind going to the next slide? Oh, little technology there. Where's the teenager when you need him? I will say this, like all great neighborhoods, it's a good grocery store. Stella Grocery is right across the street from this property. But in addition to that, there's a Whole Foods just at the south end of the Scott's Addition neighborhood. There are a number of other top companies, including CoStar. For those of you in the real estate business, you're familiar with the name, where they're moving and have dedicated a number of employees moving to the area, many of them adjacent to or inside of the Scott's Addition neighborhood. So the property itself really will be best in class, not just for the Scott's Addition neighborhood, but best in class in all of Richmond. Arguably, there are some great properties in Richmond. However, when this is delivered, true to Greystar's form, this will probably be the absolute best that Richmond's ever seen. There'll be 4,300 square foot ground floor gym with some additional space as well. Again, 350 units. There's plenty of space. There's big breezy walkways, wide open, 4 different courtyards. There will be a nice, very large size lobby area, package delivery, all the amenities you could possibly think of, bike storage, planned social, there'll be all kinds of social community events as well. But in addition to that, sun decks, pool, indoor club room, indoor lounge, gourmet kitchen for outdoor entertainment. So really truly having the ability to have this outdoor indoor space. All of this planned in the design before the pandemic. Many of these features and amenities now obviously becoming more of a focus in the pandemic and beyond. So having the wide open spaces and the outdoor spaces is really going to prove to be a benefit as we move into lease up once this is constructed. Mark, go ahead to the next slide. Interior as well, before we get into the offering, I just want to say the interior finishes. One of the great things about having a partner like Greystar on a project like this is they get to use their international scale to be able to get high quality at great value. So the construction dollar gets stretched much farther when you have that type of scale. We get scale on this project anyway. It's a $32 million total offering size, about a $90 million, $94 million total project. Big project, you're going to be able to get some scale and some price discounts just because of that. Partnering with Greystar gives us even more there as well. Go ahead, Louis.
And Richmond's a state capital, and state capitals rarely have a recession. It's also the home to a number of colleges and universities. And that's what's drawing these large CoStar, Amazon, Facebook type companies are the educated workforce. And many of them are leaving the expensive coastal parts for the Southeast where it's much less expensive. These are also the places where we like to buy apartments, medical properties, and industrial properties.
And yeah, to echo that, an educated workforce, University of Virginia, University of Richmond, Virginia Commonwealth University, medical schools, William and Mary. Obviously, Virginia has a rich history of some top quality educational institutions. A lot of those students are choosing to stay, and Richmond has become the place for people to stay. And a lot of it has to do with the fact that the employers are finding the high quality employee. And then because of the cost of living, really being able to keep that rent to income ratio at that 20% or below. Even in the single family housing, which is very constrained in the Richmond area, which is starting to get priced out a little bit. You still see an affordability compared to the Washington, D.C. area, or even some of the other urban core cities, gateway cities. That is extremely favorable. And, we're going to, obviously on the rent growth rate, we continue or expect to continue to see that as well. So on the offering, go through the numbers, but realistically, the whole purpose of this is incredible real estate, but the purpose is to take advantage of the opportunity zone. So that's to reduce or permanently eliminate capital gains taxes, generate attractive risk-adjusted returns, and then have the return of the investor capital with a nice equity multiple as well. You can see some of the numbers here on the offering. It is a good sized offering at 32 million. We have just under 29 million available as of today. Thank you to anybody on the phone who's already invested. Truly appreciate it. But one of the key things that Louis brought up earlier, we are in a construction phase, right? This is going to start construction really second quarter of next year. As we move into that construction phase, we're looking at about a 34-month deliverable. To 28 to 34 months or so, depending on depending on the speed. But the reality is we're also going to be moving into lease up at that point as well. Upon stabilization, one of the key factors, this is true of all of our OZ funds, one of the key factors is we will move to a permanent fixed rate financing with a cash out refinance feature, targeting between 40 and 50% of the invested capital to go back to our investors. So that is a tax-free cash out refinance. And because of the deferral of tax associated with the economic opportunity zone, ideally that will provide years before it's due in tax year 2026. So hopefully that cash out refinance is right in 2024, maybe end of 2023 or 2024. So that'll give a sizable amount of the original capital back for the ability to either pay your tax with that, reinvest it in other projects, or whatever else may be. But one thing I do just kind of want to point out on that, I hear it from everybody. And so I'm trying to eliminate a question that's coming next, but everybody's worried about which way capital gains are going to go. I fully understand that. I'm human too. I have assets as well. Capital gains rates may go up from where we are today, but the difference between paying capital gains today at today's rate, playing an arbitrage that in tax year 2026, capital gains may be 5% higher than they are today, and foregoing, remember, Lewis brought this up, a 10% basis adjustment. So just on that tax bill, you're getting a benefit of investing where you get a 10% basis adjustment. That can help against any potential tax increase to capital gains for tax year 2026. But most importantly, you have a 6-year plus tax deferral, which that money is earning, in this case, at least a 6 preferred return, or has the potential to earn that 6 preferred return. Not to mention the number one part, which is permanently eliminate capital gains, which after the 10-year hold, we are projected to hold this at least 10 years to fulfill the obligation or fulfill the focus of getting that complete elimination. Not to mention the fact that this will move to a completely tax-free on gain, and we are targeting it just south of 3x on the equity multiple, as you can see here, over a 14 IRR target, not including tax benefits. So again, a generational opportunity to take advantage of an incredible opportunistic development in a premier neighborhood inside of Richmond with Greystar Partners, premier developer, delivering really what's going to be one of the best projects that we've ever had the opportunity to be a part of, let alone take out to our investors. So thank you. That's just kind of the high level on that, Mark. I think the next slide is just questions. But Louis, anything else you want to add before Mark opens it up?
No, let's see if there are questions. I know people get confused about some of the tax features.
Yeah, well, obviously, who is appropriate for the 1030, not the 1031, excuse me, for the qualified opportunity zone? I mean, is there a certain profile that you need to be in to obviously invest in something like this?
Accredited investor with a capital gain, interested in tax advantage investments.
Right. And the typical, obviously, the structure of this, they have to be held for a certain amount of time and you need a commitment of time. And what would that be?
Well, to get all the ozone benefits, you have to hold for 10 years. So it's a long-term investment.
And
Right.
Neil, I'll
And
just add, one of the big things people ask about liquidity, you know, there is really no intentional liquidity of the full capital amount until after we sell the property. But I highlighted the one of the liquidities, which is that cash out refinance, 40 to 50%. It's really going to depend on valuation when we go to refinance. But then in addition to that, we will also start quarterly distributions once there's NOI. So when it moves into managing the asset after it's leased up and, you know, earning the rental income, we will be targeting and passing that through to investors on a quarterly basis. So cash flow is not limited. It's, you know, there isn't cash flow for the years of construction, but then beyond that, people will start receiving cash flow. So the lockup of 10 years doesn't sound as bad as it really could be, if you will.
And there's a catch up, there's a makeup. So the investors catch up until they've earned their full 6% preferred return.
Right. And one of the questions always comes up on the qualified opportunity zone is, you know, you build this building and let's say in 5 years, you know, there's a buyer. What happens to qualified opportunity zone if you have that situation?
We're gonna hold for 10 years.
Well, you do have the opportunity to sell. There was a new provision that was written in that allows you the opportunity to sell and then redeploy that capital into another OZ within a 12-month period of time. It is certainly not our intention. We have this underwritten. We like the clarity. Our investors appreciate the clarity. Looking at both the underwriting through the construction, but then once we deliver it to market as well, being able, you know, in our experience, to run it as an asset and to be able to have that cash flow as well. So it's certainly not our intention. Now, Neil, if you have some ridiculous amount of money and you want to give us $300 million, we'd be more than happy to talk to you.
We can do that.
Thank you. I appreciate it. Lois, my question is, do you think that the qualified opportunity zone is working? Is it improving what's happening in America?
It's working. There's an enormous amount of activity, construction, jobs, materials, contracts, architects, engineers. It is so frothy right now that it can be difficult to get your jobs lined up on time. So it is the construction economy is very strong, and these
Right.
neighborhoods are very active. A lot of jobs, a lot of economic activity. I mean, think we're doing mixed use apartments, but other people are doing hospitality. They were before COVID, and they will again after COVID. Think how many people work in a hotel. Think how many people work in an apartment community. Those are jobs that didn't exist before.
And what happens with COVID? I mean, has that delayed you starting this project?
It hasn't delayed us because apartments are still necessary and desirable. It's delayed people who are doing retail and hospitality until things recover.
Okay, great. I don't know, do you guys have a slide that talks about your contact information, or maybe you want to just announce how they can reach out to either Louis, Mark, or James?
Absolutely. James, go for it.
Yeah, absolutely. So capitalsquare1031.com, that's our website. On the website, you can see all of our OZ offerings, including a construction cam for those projects that are coming out of the ground. Somebody did ask here, is this OZ project you're going to have? It is one. It's live. We're accepting capital now. We've been getting commitments. We've been taking dollars in the door. We will close on the actual real estate and then start construction in the second quarter of next year. We have 4 other projects. They're in various phases, again, from construction all the way to just like this one, raising capital. We will have some more OZs coming out next year. So that's a great question. But again, capitalsquare1031.com, that's our website. You can get in touch with sales. You can get in touch with, and see more about our projects and everything else we have. And then Neil, obviously we work through the intermediary and representative channels. You always can talk to your financial advisor and get in touch with us through a financial advisor. If they're involved in real estate in any way, shape, or form, we're very fortunate that we've probably partnered with them. Be more than happy to accept and talk with your representative and tell you more about these projects or others that we have. So thank you.
All right, terrific. And obviously I'll share with you the information, everybody who's on today, and you can follow up as well. So it looks like maybe one more question came in. And the question here is from somebody: is the Opportunity Zone project you have going on just an example of a good project, or this is actually a real legitimate project? I think it's a legitimate project.
Yeah, as I just alluded to, this is one that we're raising money. We're $3 million in, 10% raised. Just started really kind of raising the money, and actively getting the capital in the door. We are closing on the land in January and constructing in beginning the second quarter of next year.
Terrific. Well, with that, thank you, everybody. I know that it's been a while. We're on here over an hour and 20 minutes, so I appreciate everybody's time. Louis, thank you again for your presentation on the Opportunity Zone and also on your panel. Appreciate that. And again, everybody stay safe and healthy out there. Look forward to seeing you all soon. And we will have that virtual happy hour next week. So hopefully Louis and Mark and James will be on there to kind of catch up with everybody as well.
Thanks.
All right, take care, everybody. Have a great day.
Thank you, everybody. Have a good one.
Thank you, Neil. Everyone, take care. Be safe.
Bye-bye.
Bye.